Hi, friends. I remind you of an old saying: those who forget lessons of history are condemned to repeat them. Now, financial markets also have a history, and it pays to pay attention to that history, recapitulate it, and learn our lessons from the past. I'm Vijay Bambwani. I'm a professional trader with 35 years of trading experience under my belt, 28 of which are as a founder, promoter, CEO of a limited company that trades for a living. In this video, I want to help you prepare yourself for a time when the markets can possibly correct. I'm not saying that the time has come now, but these are the hints that you should pay attention to as and when they transpire. If you feel my videos have been helpful to you, please don't forget to click subscribe to my YouTube channel. Click on the bell icon to receive instant alerts of any fresh videos being uploaded out here, and do communicate with me. Keep the lines of communication open via the comment section and help me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. So let's dive right in about when we can possibly get the hints from the markets itself that the market might just correct. You see, we all know that the market rally has been triggered by abundant supply of money, and that too low-cost money with interest rates almost zero. Now, there's an old saying in Wall Street that easy money, cheap money, or free money is like mother's milk to a bull market. You see, a newborn child survives only on mother's milk, and in the first 4 to 6 months multiplies his weight surviving only on mother's milk. So easy money and easy availability of money at either very low interest rates or free money acts in a similar fashion. Now, just see how the indices have doubled from their March 2020 lows, and you know what I mean. Now, what can actually worry the markets? Interest rate hikes, which means the cost of money going up. No more will the finance be as cheap as it is available now. You see, when the government wants to stimulate the economy, because right now it needs some amount of hand-holding, checks are being sent out, moratoriums on interest payments and EMIs, etc. are temporarily being provided. But after a while, the double entry system of accounting will kick in and debits will have to equal the credits if the books have to tally. So sooner rather than later, there will be hikes in interest rates, because at these low rates, no money lender or no investor will invest in the fixed income securities market, which, by the way, is 20 to 30 times bigger on a global level as compared to the equity markets. So consider the bond market as the fountain of all money supply, and the equity market the recipient of this money supply. We are basically putting the horse ahead of the cart by saying that we will focus only on the equity markets and not look at the bond markets or the interest rates. If you go back in 2009, 2010, 11 and 13, you will realize that after the global financial crisis of 2008, the US Federal Reserve did exactly what it has done in 2020, which is to flood the market with money and cut interest rates very, very aggressively. And yet after 2011 end or maybe 2012 mid, there were talks about the US Federal Reserve shrinking back its balance sheet. Now, a very polite way of saying stop doling out more money and increasing the interest rates. Now, the Wall Street guys gave it a name called tantrums. Now, is there a possibility that taper tantrums, is there a possibility that the doles that the federal government is giving, central governments and central banks are giving to financial markets could be tapered off. I think so. At some point in time, you will have to stop distributing free money because the markets may not really be all that in a dire state to want an oxygen line all the time. And when that happens, the bulls will basically feel the shortage of money power backing them up to push asset prices higher and higher. In the budget, the Honorable Finance Minister laid out, I beg your pardon, the Finance Minister laid out the roadmap for the Government of India's borrowing program for the coming year. She said the Indian government will raise 12 lakh crores from the bond market in the coming year so as to basically raise money for the day-to-day business of the government. The first thing that happened was that the bond markets witnessed a sell-off. Now bond prices fell, therefore bond yields rose to the extent that we are now within kissing distance of 6.15, 6.15. It's a multi-month high. The banks which are the biggest holders of government bonds are seeing a huge loss on the mark-to-market portfolio of their bond holdings. So far, the bull market is turning a blind eye and disregarding this phenomena. But should interest rates go up, in which case the bond yields will rise further because the existing bonds giving a lower rate of interest compared to what the government will borrow ahead at, will see another round of sell-off. At that point in time, you will see two things happen. Equity prices will come down because easy availability of low-cost money will then come to an end and India will face its own taper tantrum. And secondly, many of you, my viewers, who are holding debt funds, liquid funds and other debt instruments will see a decline in your NAV. Because the bond prices will fall, the asset which is the bond will impact the NAV and your debt funds will suddenly start compressing your returns. These are the very first signs that the equity markets are topping out and will therefore prepare you for a corrective decline ahead. I'm not saying that this would be a hard top and an absolute end of the rally. All I'm saying is that this would be a meaningful correction because the very source, the very reason why the rally has occurred, which is cheap money, would then have ended. So the cause and effect theory tells you that if you remove the cause, the effect must also be removed. When easy money goes out of the window, so will the bull market, temporarily at least. Please keep your ears to the ground for the bond yields and let yourself be forewarned because forewarned is forearmed. On this cautionary note, I bid goodbye to you in this video. I wish you have a very, very profitable day ahead. Vijay Bambwani signing off for now. Thank you for watching my videos. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.